Morning, all. Welcome to the Node, your place for news, interviews, and education. I am Mike, aka Veteran Crypto, and with me, as late as always, is David. One of these times, he's going to show up before we go live. I challenge him to do that, so it makes it a lot easier to get set up. So, anyway, enough about that. So, good morning to all of you out there that are tuning in. We have we have some news. It'll be up to you if it's good or bad or whatever. But David's going to be doing some deep dives into the TAO subnets today. So it's something that he's been talking about wanting to do for a while. So we'll get into that in the second half of the show. But before we do, let's get into the socials. So if you aren't already, if you could come over on YouTube to at the Node Network, all one word, and if you find the information that we put out, valuable to you in some way, if you could subscribe, like, share, help us grow the channel. It doesn't cost you anything. It's just a click of a button, and it helps us immensely. So greatly appreciate that. The our X account is at the node_network if you want to follow us there. As you can see, we're live there as well. And our official website is thenode.pro. And so this is where you can find all of our offerings, most of which are no cost to you. Hold on, let me get the sun out of my eyes. Seems like this time of day, the sun always reflects off the truck windshield into my face. All right. So if you want to use DeFi University, which is our no-cost educational course, with it's all structured. It has slide presentations. It has videos. It has quizzes. The checks on learning. All of that. No cost, no gimmicks. We just want to educate you. So if you want to find that, it's there. The newsletter. David's putting the finishing touches on this. This is our AI newsletter where you can generate the newsletter based off the assets you are interested in. So, whatever, if you know the ticker of the commodity, the stock, the crypto that you're interested in, it will go out there and it will find the trading levels, the liquidity pool ranges. It will find all the news, social media posts that are, came out that day for your assets with hyperlinks to all of it. So let's see what it's going to do for us here. Let's see. So, as you can see, it gives you the ETF flows, both in and out. It gives you the ranges for your support and resistance. So that's what you would use for liquidity pool ranges if you're doing concentrated liquidity pools. Your trading ranges. It'll give you all of this, and it gives you links so that you can verify, the data that we're giving. It's important to get good data, but it's even more important to verify that data. So you should never just take things for face value. You still need to do a bit of your own research, or at least verify. It's what we preach here. We don't expect that the information that we give you, that you take it at face value and go and invest, your money in what we talk about. We're going to give you what we find, both good and bad. It's up to you to make sure that the information that we give is 100% accurate. We are human. We're going to make mistakes. Do not count on anyone to just spoon feed you information about these projects. You need to verify. You need to do your own research before you invest. It's like we're not here to tell you what to invest in. We are simply here to educate you. We are educators. We are not influencers. I don't want to influence you to do anything. I just want to give you the tools and the knowledge to do it and to maximize your chances for success. So anyway, that's the newsletter. On Tuesdays and Thursdays, David and Ellie, are going, and David is putting Ellie through his coaching course live on the Market Wrap at 1 p.m. Pacific, 4 p.m. Eastern at the close of the markets. And if you are interested in potentially doing this, having David coach you, is you can select a time for that you want to meet for a no cost consultation, and he will go over. You can talk to him about your portfolio, how you want to invest, all those different things, and he'll give you an idea if the coaching is right for you. So the community. If you want to join our no-cost Discord, if you want to join our premium channels, as far as the live calls that David does with the DeFi University kind of alumni, where they are successful DeFi investors. They have video calls, roundtables, where they all get together. Usually, David does like a lesson, and then everybody on the call, they just randomly share, opportunities that they find, or maybe even mistakes that they made, and with the group. So it's a great place to find mentorship. So again, that aspect is $99 a month, and then if you want to see all the different shows, because we are truly a network. If you want to see all the live shows and recordings that we have each day, you can come here. You can find, the Node show is Monday through Friday. Blockchain Report is Monday, Wednesdays, and Thursdays. That's where Jeff goes and does deep dives on early projects. If you want to do check out the Market Wrap with about 15 to 20 minutes of technical analysis at the end of each day. David does that, and again on Tuesdays and Thursdays. At the end of that TA, he does his live coaching call with Ellie. We have our evening shows. Myself and Jeff do Crypto and Chill on Tuesdays and Fridays, so tonight. And then Jay and Ellie have Gaming and Chill on Wednesday evenings and Sunday evenings. And then there's Purple. This is that $99 a month live call that David does with the community. So if you're interested in any of that, that's where you find it. So how's it going, David?
Doing okay. Had a little bit of a problem earlier this morning, Mike. So I've been working on this newsletter, right? I've been working my ass off on this fucking thing. And I upgraded the back end in the newsletter to something, Gemini 3.5. So in Google Cloud, I can use these new models, right? And in the Google Cloud workspace, like the UI, the user-facing version of it, you don't get like real-time updates for how much you've spent on these models. I kind of fucked up yesterday, and I spent $250 without realizing it on.
Oh shit!
Yeah, dude. So I just had to fix that, and so I'm gonna be taking the model that I was using to like pull all of the API data from a dozen different sources, make sense of it, and then write the newsletter. I was thinking that I could get away with using Gemini 3.5 for that, the newest model. Turns out it is extremely expensive. So building a plan here to just completely remove 3.5, and so that happened. I wake up and take a look at because the first thing I do every day is I take a look at my cash accounts and any bills. That's the first thing I do when I hop on the computer. And so I log into Google Cloud, and it's like, oh, what is this big, like big blue bar here? Like this is a god candle, but not a good one.
No.
So yeah.
Yeah, no. The first thing I do every morning is I check the analytics. I go on all the different socials and stuff like that and check the analytics and see what the the work that I did the previous day, if I did the right things or the wrong things to grow the channel. And so far we're doing great. Almost it looks like we're going to hit over 100,000 views before the end of the month. So pretty excited about that.
I know. I'm excited about that too, man. It's just exciting. It's a great thing. I mean, we're growing as just about every other crypto channel is shrinking. So it's pretty cool to see that.
No, absolutely. It tells me we're doing all the right things. Our focus on integrity, our focus on being unbiased, and given the full picture on all the deep dives that we do, pointing out the good and the bad, just not accepting any sort of compensation for talking about projects or the interviews that we do. We don't do fluff pieces. We ask the hard questions. I think people are hungry for that. I think people are tired of people shilling projects and and just trying to make a buck off of everything. So that's one of the reasons why we're so focused on just kind of giving away a lot of the stuff like DeFi University. Is we truly just want to educate people, and and if people want to choose to open their wallets and and help support us, then that's up to them. But not necessary. And as always, please, at a minimum, click the like button, share it out, follow us. It's free and it helps us out immensely and allows us to just not have to be like everybody else, not have to get paid to talk about projects and stuff like that. So if you can do that, we greatly appreciate it. But
100%.
Let's go ahead and jump into the news. So it looks like it says the broader digital asset market enters the weekend in a consolidation phase. Bitcoin is currently trapped in a tight 4-day trading range between 76 and 78, heavily influenced by shifting geopolitical expectations surrounding the US-Iran diplomatic discussions and slowing spot ETF outflows. While the majors remain directionless, risk-on sentiment fueled by tech earnings has triggered an altcoin rotation into AI tokens and platforms like Hyperliquid, while privacy coins like Dash, ZEC, and XMR are experiencing sharp profit taking. And that's something that I'm seeing with Ondo too. Is Ondo's been seeing some great price appreciation, despite its poor tokenomics. There's a lot of people out there shilling it and trying to get people to buy into these green candles. I'm screaming from the rooftops, take profits. But if you look at the data, the on-chain data, Ondo Finance, they moved a bunch of Ondo onto exchanges over the past week or so.
Because they're dumping it, isn't it? Like
they are.
Yeah.
They are taking profits while everyone is buying into this hype. And this is what Ripple does. This is what Ondo is doing now, and this is what a lot of these projects with poor tokenomics, because that's how they fund their operations.
Right.
Those of us out here that are buying these tokens with poor tokenomics, you are funding them building legitimate products and services with no guarantee of any sort of return on your investment. People, if you don't understand what I'm talking about, please do your own research. Watch our deep dives, that we've done on these projects, because you might be surprised. What the lack of fundamentals or the lack of solid tokenomics that these have, because Ondo is nothing but a governance token. The price going up is manipulation. It's hype. It's speculation. That's all it is.
Yeah, and we're going to have a library pretty soon of all of our deep research reports. So, I can't build, 10 things at once. So I'm just focused here on the newsletter. And, once I get that newsletter done, then I've got a couple of other things, after that we have already talked about. But, building a library of all of the deep dive research so that anyone can jump in and review, what it is that we went through on the live show. I think that's going to be super valuable for people. And, we go through so many of these different projects, Mike, and, we see all of these different tokenomic schemes. And, when I see something like Ondo moving to the upside, in fact, where is Ondo trading right now? I think when I saw it was plus 10% or something like that today.
It's been seeing like some really good pumps and stuff like that, but I can't stress enough to be taking profits.
Yeah, look, I don't have a crystal ball, obviously. No one does. And so,
No.
Could it go higher? Sure.
Taking profits.
Right. Exactly. You won't go broke taking profits. But can it go higher? Of course it can go higher. Are the tokenomics awful? Yes, they're awful. Is the team dumping 8 figures a month of the token? Yes, they are. So, make of that what you will. but I wouldn't buy it. I wouldn't buy Ondo if I owned a bag of it. And I see Bitcoin getting ready to make another, maybe another move to the downside. Yeah, I just think to myself, well, even though these altcoins have gotten a nice little pump, that's exactly the type of move that would pull everyone back in. A little bit of a pump. Let's double up. From the lows, the recent lows from Feb. Get these alts to double, pull everyone back in, get everyone all excited about alt season. I see people on X talking about alt season. It's like, dude, alt season, huh? So you draw everyone back in, get everyone long, even better, get everyone levered long, and then just dump it to 50 or below 50. And Mike, whenever I take melatonin to help me go to sleep at night, I almost always have like more intense lucid dreams. And I had a dream last night that I was sitting at a coffee table with Michael Saylor. And Michael Saylor, dude, he was wearing like a fishing outfit. He usually wears that suit, but he's wearing like a fishing outfit and a fishing hat. And I was sitting at this coffee table talking to him, and all he wanted to hear was, "Yeah, well, pump the bags, man, number go up." But I had to tell him like, "Hey, I think that it might go down first," and he got pissed. He stood up and he walked away, started talking shit.
You made Michael Saylor rage quit.
Yeah.
All right. Well, it looks like prediction markets face massive state versus federal jurisdictional war. The regulatory battle over on-chain prediction markets has escalated dramatically following Minnesota's total ban on these platforms. So that freaking dillhole Tim Waltz signed a bill making it a felony to operate or advertise prediction markets within the state, labeling them unlicensed gambling. The federal lawsuit
in Minnesota, the land of the Somalian scammers.
The guy that basically enabled and benefited from
decades of fraud.
Somali scams is one to go after prediction markets.
Wow.
All right. The federal lawsuit, in a swift countermove, the CFTC and the Department of Justice filed a federal lawsuit against Minnesota, seeking an immediate injunction. The federal government argues the state is encroaching on the CFTC's exclusive regulatory authority over event contracts. The legal setback, compounding the friction, the U.S. Ninth Circuit Court of Appeals denied a request from Kalshi and Polymarket to halt separate enforcement actions in Nevada and Washington state, forcing them to fight parallel battles in state courts. It's funny how it's always these Democrat states.
I know it always is, Mike. And they
don't like competition. They don't like competition on their scams.
Yeah, but it's so much worse than that, because the type of shit that they do, read about the Civil War, man. It reminds me of the Confederacy, saying like, hey, federal law doesn't apply here. And we're actually not going to abide by federal law. We've got our own stuff going on here. That's what the Confederacy did, man. These Democrat states, these Democrat cities, and these Democrat politicians, more secessionist than communist than anything else. Pretty horrible. But to see that guy Waltz tampon Tim out there, like, trying to ban prediction markets, they're just binary options. That's what those markets are. They're options markets. And people love them because you can, express your opinion on the outcome of anything. And it's extremely valuable. So I don't know.
Even if it's not valuable, I'd see it as freaking. The point that I see is that we're fucking adults. We should be able to spend our money however we want. If we want to throw it away on something as stupid as prediction markets, that's our right. It's not the government's place to tell us what we can and can't spend our money on.
Yeah, no, it's definitely not. It definitely is not. And government overreach is what Democrats are good at. And taxation, overreach. That's what they like. So it doesn't surprise me that lefty Minnesota is doing something like that. That's a real shame, man, because if they would, instead of, trying to make it illegal for people to, operate or use a prediction market, maybe instead of doing that, they could view it as a source of revenue to improve infrastructure or, something along those lines. I mean, we need more infrastructure investment. Um,
Yeah.
yeah.
All right. So a wave of high-profile DeFi closures hits the sector.
No, yeah.
So May 2026 is proving to be a stark period of contraction for decentralized infrastructure, as several prominent teams announce wind downs due to unsustainable monetization and intense L2 competition. So Zero Network shuts down. The
Yeah, I saw
Xeron
that.
team,
Yeah.
yeah, announced the gradual shutdown of its gasless Ethereum Layer 2, the Zero Network. Launched in late 2024 to eliminate gas barriers, the team is pivoting entirely back to its core wallet and API services. Users must withdraw all assets by July 31st, 2026. So if you have any liquidity, or assets in there, make sure you get them out.
Yeah,
Ever,
that's
oh,
yeah.
go ahead. Sorry, go ahead.
Yeah, that's a shame. So it's not just Zero, and maybe you were about to get to it. Are you about to talk through all the rest of them that have shut down?
Yeah. But go ahead if you got something.
Yeah, so I'm trying to find it in my X. I've got a bookmark somewhere here of all of these different protocols that have been shutting down. There's a lot of them. A couple of automated liquidity managers that I used to use, um, but I can't find it in my bookmarks. I've got too many bookmarks here, but there's a lot of projects that have been shutting their doors, and it makes sense, right? Because this stuff is not free to run, and it can actually be quite expensive. As I learned accidentally this morning. Uh, so like if you're not well funded, then you've got a limited runway, right? And if you're building a crypto project and the thing doesn't actually generate any revenue, well, then you're not going to be able to last for very long.
Mm.
So yeah, zero going away. There's a couple of there's actually quite a few. I think there's like 30 that had to shut their doors so far over the last month. So yeah, we might just be starting to see the beginning of what did you call it, Mike? The great culling, something like
Yeah,
that. Yeah,
yeah,
I think that the great culling will really accelerate if we get another leg down out of Bitcoin and ETH and Sol,
yeah,
because dude, all of those treasury companies, uh, their shareholders are not going to be too happy if they're sitting on a 90% drawdown on their ETH bag or their Sol bag or whatever it is. So that could mark the capitulation bottom if you
yeah,
start to see these treasury companies liquidating their positions at the lows. that
yeah.
could that could mark the bottom, but we haven't seen that yet.
No. So the next one up, Everclear ceases operations. The cross-chain liquidity clearing layer, Everclear, is closing its protocol foundation and research arm, despite processing up to 500 million in monthly volume at its peak. The project failed to secure a viable B2B revenue model before their runway exhausted. So basically, their funding is their runway, and they weren't able to get to a point to where they even with 500 million in monthly volume, they weren't able to get to a point to where they were profitable. And that's where a lot of these tokens that have these poor tokenomics, and the organization, the company, is dumping them, like Ripple with the 1 billion of XRP monthly unlock, and Ondo, where they own like 65% or something like that of the tokens, and they're dumping, like David was talking about, 7 or 8 figures per month. That is how they are staying in business, while they are building out, in some cases, very solid tech, and that, because Ondo is doing great things, the company Ondo Finance, but they need to have the runway to be able to build up to the point to where they can flip the switch to being profitable. I mean, it's kind of like, with us, we just have very low overhead, so we're able to pay out of pocket, but we're operating at a loss, but these companies cannot do that. When you have buildings and employees and operating, there's only so long that you can operate off of whatever your nest egg is, your startup, that you got from VCs or wherever you got that startup capital from. So I think that like David was just talking about, the more these markets dump and they're not able to sell those tokens for as much as they used to, a lot of these projects are just going to close up shop.
But also, Mike, think about so if I'm creating a blockchain Web3 protocol, right? Uh, and I'm selling block space. Let's say I'm Ondo or whatever, protocol XYZ, doesn't matter. And I'm selling block space and I've got $1 million in the bank, right? And that's going to last me for 6 months. And, I've got that amount of runway, but I've also got this token, and this token is completely disconnected from, any fundamentals of the actual business that I'm building. And let's say that business that I'm building doesn't actually make any money. Like, definitely not enough money for me to pay all my employees. Even if I don't have very many employees, I probably have overhead, right? So
Yeah.
if the business that I've built, if I'm protocol XYZ and I've built this business and it doesn't generate enough revenue for me to keep the doors open, I've got a certain amount of VC funding that's going to run out after the course of a couple of months. And my only choice is to just dump the token that I've minted that's valueless, no value, like made up Fugazi token. The only way I can keep the doors open is to dump that token on unsuspecting retail. Like, how is that not just some type of horrible scam? And how many projects are like that? Like, it seems like there's a lot
The
like that.
majority.
Yeah. Yeah.
Especially a lot of the older projects. That's what I've noticed. And again, I mean, and me saying this, don't take it as go out and buy it, but Canton, that's one of the things that really impressed me with how they launched. 100% of the tokens in existence were put out to the market. The team kept none of the tokens. VCs and early investors got no tokens. It has decent tokenomics. I mean, there's things that I look at that I would like to see different, but taken as a whole, I think that it has solid tokenomics. So I mean, go do your own research. We've done some deep dives. We've had Shal Kafur on, who a couple of times, who's one of the co-founders of Digital Assets in Canton. You got to find these projects that have solid tokenomics, because if you're going to buy these tokens, you want to maximize the potential for being profitable long term. Unless you're just going to trade the short term volatility, then it really doesn't matter. Then just follow whatever the narrative is, or whatever's being hyped. There's ways to make money doing that. But if you're genuinely trying to invest in solid projects long term and stack bags, you do not want to be getting involved in these projects with shitty tokenomics.
Yeah, no, you really don't. And most of them, or many projects, have pretty horrible tokenomics, such that the token itself is completely disconnected from any money that the protocol or the business is making. So, yeah, but projects that have legit tokenomics, like Canton or Hyperliquid, one thing that they haven't. No. But one thing that Canton and Hyperliquid have in common is they make money. Like, isn't that's a novel concept in this space,
like
huh?
$2 million a day, and they're just getting started.
Right? They actually make money. And Hyperliquid, fresh all-time high yesterday. A Canton, dude, I think Canton, the moment that it hits equilibrium, that thing is just gonna run. That thing is going straight up.
My fingers are crossed, and like I said, I got a bag, and I'm not a lot. I'm earning like two or three free tokens a day for holding it on the Braun wallet. We'll see.
We'll see.
What I would be excited about is to see some DeFi plays where I can use my Canton to earn more Canton. that validator that we got approved for. I'm going to make a note. I need to dive into that and see if that is worth pursuing, because I know that a lot of the rewards have been slowed down, as it pertains to like the validators and things like that, which is good for holders because that means that there's less tokens being minted. But again, it's kind of a double-edged sword, because you don't necessarily, I just need to do more research. So let me look at that. Canton validator. All right, so I'm going to do that after the show. Let's see. So I got institutional shuffles. U.S. old money recalibrates 13F positions. I might need your help with this one. The latest round of quarterly 13F regulatory filings has exposed a major tactical divergence in how massive institutional funds manage the recent market pullbacks. Harvard University pivots. So those that don't know, Harvard has a massive, it's not a trust. What is that called? Like the billions of dollars they have?
Yeah, their endowment.
Endowment. That's what it is. They are very well endowed.
Yeah, those fucking communist pieces of shit over there, dude.
So Harvard Management Company, which oversees the university's massive endowment, aggressively slashed its crypto exposure. The fund cut its iShares. They're selling the bottom, or bottom-ish. The fund cut its iShares Bitcoin Trust holdings by 43%, dropping from over 5.3 million shares to 3 million shares, and completely exited its BlackRock Ethereum Trust positions. The AI reallocation. According to filings, Harvard didn't move back to traditional cash. Instead, it rotated that freed up capital directly into AI infrastructure and computational chain projects, signaling a shift towards hardware and AI plays over spot digital store of value assets.
Yeah, so the 13Fs, those are required filings. I think it's every quarter. And so we just got, Q1 data up to March 31st. And basically there's been an altcoin exit. So, it's not just, Harvard's endowment exiting an altcoin position. It's also Goldman Sachs. These guys are what you would consider to be smart money, in the know, and they liquidated their entire XRP position, their entire Solana position, and they've significantly cut their stake in that Ethereum position by 70%. But they're still holding Bitcoin, although they did trim that stake by 10%. So, we're definitely seeing a rotation away from, dog shit coins like XRP and Solana, and Ethereum to a certain extent too. I mean, dude, if you've been an Ethereum
has performed terribly.
Horrible, just horrible. I mean, it's basically done nothing. If we just zoom out here, if you bought ETH in April of 2021, you're flat. Like it just moved. Oh, sure. It's just basically moved sideways. So, and we can take a look at all the rest of them too. These coins haven't exactly performed, well at all. So if I just grab, let me go ahead and remove this here and remove this. I just want to make this a little bit cleaner so that we can see this. And I'm going to grab that arrow. So right there, that is, not the red line. We're going to use this one. Let me go ahead and hide that drawn object just real quick. Perfect. Okay. So this is 2021 April, all the way back there. What was ETH trading for back in April of 2021? $2,100.
The same thing it's trading for now.
Right, exactly. The same thing it's trading for now. So yeah, if you had bought ETH back then and held it, you've made exactly zero gains. And it's been a wild ride. At one point, It was up at 5K in 2021. In last year in the summer, it was up near 5K. It just put in a double top. And, my conjecture here is that it's going to put in a double bottom. So I think that ETH is going to move back down towards those lows from last April. Uh, all it's got to do is fall out of this little parallel channel here. And it looks like it really wants to. It's getting very, very close. So rather than adding to my Bitcoin short, I just opened up an Ethereum short last night. So yeah, I'm just short Bitcoin, I'm short ETH, and I'm going to leave it like that until the positions really start to show me a nice profit. Then I'll add to them. But yeah, taking a look at Ethereum, it looks like crap. And same thing with Solana. Solana, it's still a casino. I mean, they're starting to add more stuff on here, more RWA items. But as far as like Solana altcoins, Solana
Well,
ecosystem altcoins, there
I know,
are.
I know there's a couple other chains that have actually started outperforming Solana as far as volumes and stuff like that. Because I was saying it months and months and months ago. When the meme coin craze dies off, Solana volumes and stuff like that are going to get hurt freaking drastically. Because I mean that's basically what it is. Is it's the meme coin casino chain.
Yeah, and I mean, if you bought Solana back in, September of 2021, it's just moved sideways since then. I mean, a ton of volatility, of course, but you don't have any gains. If you bought Sol and have been holding it for the last 5 years, you've made exactly bubkiss, zero, nothing, nada. So yeah, that's kind of tough. And the moment that this thing breaks down and makes a move to $30, all of those Solana treasury companies, oh dude, because many of them bought like in the 200s, like up here. Many of those companies were buying Sol up here. So, for them to hold through an 80+% drawdown, uh, I don't know how their shareholders are going to react to something like that, but it's not going to be good. So I'm going to continue to watch these treasury companies for signs of capitulation the moment we get another leg down. And then, the other one that Goldman exited its entire position of is this thing, this horrible, evil scam token, XRP.
Yeah.
So this thing is, we talk about tokens where they're completely disconnected from the fundamentals of the business.
Mhm.
I have no idea if Ripple Labs actually makes any money or not. But if all they've got to do is just dump XRP on the open market on retail, they're not allowed to sell it to institutions. They can dump on retail legally, though. So if all they've got to do to support their business operations and continue to buy up like random companies is dump XRP on retail, use the proceeds to then go out and pay for operations or buy businesses, well then that's a horrible scam. There's no value creation there. So I'm just thinking to myself that this one, if it makes a move down towards like 30 cents down here, I will never buy this. But I'm thinking that it'll
Well,
maybe.
maybe a short-term trade.
I don't even want to trade it because it's a little bit too volatile. Like when it gets pumps, it really gets pumps. And
Mhm.
yeah, so I'm just going to watch it from the sidelines. But yeah, this one, have you ever operated natively, Mike, on the XRP ledger? It was not a good experience for me. So
I had nothing but great experience using it. As far as sending XRP and things like that. But I mean, that's I cannot with what I know about XRP. I just cannot, in good conscience, invest in it because I don't see it as an investment. I see it as me throwing money at Ripple so that they can grow their business that I'm not going to have any part of.
right, but I mean, the conversation that we're having now is really about like how these protocols use their tokens as a way of raising cash just to pay for operations because the business itself doesn't actually work. So if the business itself doesn't work and they're dumping a valueless token to raise cash to keep the doors open, that's some type of scam. You know,
Well, a lot of that money it could. I'm not saying it is, but and I'm sure that there are projects that do it. But that money that they're from selling tokens, they can pay influencers. We get emails all the time. I get emails all the time with offers to for for to basically shill projects, and they'll pay us, and I tell them fuck off. It's that's it happens, and that's what you see whenever these all of a sudden, like Ondo. Nobody was talking about Ondo, and then all of a sudden, out of the blue, you got it's all over social media that and they're pumping the token based off of some good news, and that's like all I see on my timeline now, and all the while Ondo Finance is dumping.
yeah,
You know,
so
ah, if
it's
it
the
walks like a duck and it talks like a duck.
it's the same type of idea, whether we're talking about Ondo and their horrible tokenomics, or we're talking about XRP and its horrible tokenomics. It just makes me think like, okay, if XRP and Ripple, they've had over a decade to ship something, to build something that like people are actually going to use. And, this XRPL DEX, I don't know if this actually works. Like, I've tried to use this in the past. The blockchain built for business. Fuck off. This is bullshit. There's no business going on XRP Ledger. And I'm trying to figure out how to even use this.
Let me check
So
DeFi.
yeah, I was just looking at DeFi Llama, but this stuff is the UI UX is so horrible. Like how even do you use this? Like it's not immediately self-explanatory. It's tiny, and it's doing nothing but bleed TVL. So it says AMM pools for the XRP Ledger blockchain. I don't know, man. I think that the XRP Ledger is fake. I think it's not real. I
Well,
don't think that it provides any
pull up
value.
xrpscan.com and look at that data because, yeah, I mean, they would tend to agree with you because it's all flat or, bleeding off.
Well, see, Mike, what I'm trying to find is like, I remember being able to connect my XRP Ledger, my native wallet, to like they had a DEX like up front. It was horrible. It was really horrible. But I
Yeah.
was able to like connect a wallet to it, but I
Hmm.
couldn't actually do anything. Nothing worked. And so, like, when I'm looking at, they're talking about preview our new features, explore what the community is building, smart contracts and AMMs. It's like, dude, we had that stuff on Ethereum back in 2017, so like,
Well, and
and
it's not even, in my understanding, unless something changed, and it always is the smart contracts aren't natively on the XRPL. Flare, a separate project, actually built out smart contracts as an afterthought to for the XRPL because they didn't have them natively. They didn't have smart contracts, and I bought Flare back in the day when I bought XRP for that reason because at the time the tokenomics were different. RLUSD wasn't around, but
yeah, man.
I sold that off during the last pump it got.
Yeah, no, I would like to see this project just go away. I don't want crypto to be associated with nonsense like this. Um,
I just want to see all the vaporware and just all the freaking terrible, do nothing projects go away so that fucking TVL can go into the good solid projects.
Me too. Me too. I agree 100%. And speaking of good, solid projects, in about 20 minutes, I've got some interesting stuff on. So yesterday, Ellie and I were going through Bittensor. We
Yeah.
were taking a look, operating natively on Bittensor TAO, and we swapped into a Subnet alpha token, and that Subnet alpha token is called dTAO.
Well, didn't
And
it pump like 100% in like just the past like couple of weeks?
600%.
Oh,
And
fuck.
yeah, in the last 4 weeks, actually in the last 4 weeks, it's done 1100%.
Okay.
But like just recently, it's up 600%. And
So are these subnets kind of like layer twos on TAO or something?
they're not layer twos. What they are is they're much more like a business. So the Bittensor TAO mainnet you could think of as like the treasury layer. Like that's
Hmm.
the layer zero or the layer one, I guess you could say. And
Hmm.
TAO is the treasury asset. Everything's priced in TAO. And then these subnets, they perform some type of computational work. They produce intelligence. And if the intelligence is valuable, then the alpha token, which you could think of almost like shares of stock in a company that produces intelligence, these alpha tokens, if the subnet works and you swap into the alpha token, it's almost like holding a share in that business. And
Hmm.
so, just from yesterday to today, I'm just trying to open up that Talisman wallet that we set up yesterday. Um, but I'm pretty sure that that position has actually done pretty darn well just in the last day. Yeah, so I mean, up up another 15% just in a day. So
Hmm.
that's pretty cool. That's pretty cool to see that. Um,
Well, we got about 10 minutes left before we go into the deep dive. So let me touch on a couple of these. We got retail and centralized finance. So crypto giants move deeper into TradFi. Major consumer-facing exchanges are accelerating their expansion into traditional banking and brokerage products to combat lower crypto volatility. Kraken and Coinbase roll out stock trading. Both Kraken and Coinbase have rolled out fractional stock trading to the majority of their US user bases. To sweeten the deal, Kraken has integrated direct DeFi backed yield protocols, allowing users to earn roughly 5% APR on idle balances directly within the app, positioning it as a direct competitor to high yield bank CDs. The legislative catalyst. The product push is being heavily lubricated by rapid progress on Capitol Hill. Compromise discussions surrounding the Clarity Act and the Genius Act are giving U.S. fintech platforms a clearer blueprint for distributing stablecoin yields and asset backed digital products legally. Um, it's like venture capital. Foresight Ventures backs PopDex with $30 million. Despite a quiet retail spot market, the on chain derivatives sector is pulling in heavy infrastructure funding. The mega round. Foresight Ventures announced a 30 million strategic seed investment in PopDex, a new perpetuals decentralized exchange or perps dex focused on capital efficiency and trader centric revenue sharing. The backdrop, the massive seed round comes on the heels of data from CoinGecko's State of Crypto Perpetuals report, which revealed that perpetuals trading volume topped $751 billion in January alone, proving that on chain leverage and derivatives remain the stickiest revenue generators in the current DeFi landscape. So I know this is something that you're deeply entrenched in. So what do you have to say on that topic?
so one more time, Mike. What exactly was the question about the perpetuals trading, all of the volume on chain, and some of these TradFi assets starting to come on chain?
So
One
basic,
thing.
yeah,
Mhm.
go ahead.
Well, one thing that comes to mind for me is the amount of open interest, the amount of levered open interest in perps right now. Um, so let's see if I can dig up a number there. Tell me about the absolute dollar amount of levered open interest in perpetual futures crypto markets right now. So I think it's some massive number. And Yeah, open interest. Yeah, wow. So it looks like the all-time peak was over 210 billion, but now we're sitting at, closer to, it looks like 60 billion or so. Um, so that's still a ton of levered open interest. And much of it is, on Bitcoin, Ethereum, and higher volatility altcoins. Although we have seen a flight from altcoins towards, higher quality stuff. Think, tokenized RWAs. So on Hyperliquid, for example, the S&P and Nasdaq and gold and silver futures, those have seen, a massive amount of volume shift from altcoins into RWAs. So there's a lot of open interest here. And even though, 210 billion in open interest from last cycle, that was the peak. Now we're sitting at below 100 billion in open interest. That's still a ton of leverage out there.
Hmm.
So what I'm thinking about here is what happens if we start to get, a little bit of a move down? What happens if we start to get some long liquidations on the downside? And what could be a catalyst for something like that? Because those could pick up steam really, really fast. The only thing that I'm thinking about here is yields, is rates. So, when I think about yields and rates, I'm thinking about the US 10-year, which I'm showing here, but I'm also thinking about yields in Japan, the Japanese 30-year, up at 4%. It was up at 4.2% the other day. So as these yields blow out to the upside across the entire developed world, eventually stocks are going to care about that. Right now, they don't. They don't care, not one bit right now. But eventually, it's going to matter. And eventually, that's going to matter for crypto. So, if I'm taking a look at total market cap and I see, total market cap getting rejected at that 200-day moving average, you start to also notice the same types of patterns on multiple time frames. So, what I mean by that is if I just grab my brush tool, this bear flag pattern right there, if I just go ahead and zoom in from a daily to a 4 hour, and then we maybe take a look at this, um, it looks similar. It's similar. So I could see a little bit of a flag here. Maybe I'm reaching. Sometimes it's easy to squint just right at a chart and find the pattern that you're looking for and then fall victim to confirmation bias. But, when I take a look at this pattern, this is definitely a flag. This is a textbook bear flag. It's getting a little bit long in the tooth. And the fact that it's, down below that 200 period moving average and seemingly getting rejected by that 200 period moving average makes me think that, okay, it might be time for a send on the downside here. But the thing that's, supporting all of this still is, stocks, the NASDAQ. This stuff does nothing but go up now. So as long as tech is not rolling over at all, not even like a small correction, nothing, then I think it's going to be difficult for Bitcoin to really start to break down. If we take a look at IGV, this is a software basket. This is a software ETF. Um, Bitcoin has been more positively correlated with software as of the last year or so. And now that we're really seeing software start to push up towards that 200-day moving average up there, maybe Bitcoin could have another run into the low 80s. If it's going to remain positively correlated with software and software is rallying, well, then maybe there's a rally out of Bitcoin. But when I take a look at large cap alts like Ethereum, I mean, this looks really ugly. Like this is a really, really ugly pattern. And it just makes me think, okay, when this breaks down, because it looks like a when, not an if, then support's down here, 1600. So, and if Bitcoin makes a move to the downside at the same time, then there's no way ETH is going to hold 1600. And then if you take a look at the ETH BTC, so Ethereum's performance in Bitcoin terms, uh, I mean, if we zoom out here to a weekly and just take a look at ETH BTC, this has done nothing but underperform, basically since this, since 2022. This pattern here, uh, you know, this pattern makes me think that if this yellow horizontal breaks, that we might actually see ETH potentially, test the lows from last April in Bitcoin terms. So, yeah, this makes me think that altcoins, even though we're getting a pump, that because I view ETH as a proxy for altcoins, it just generally speaking. So if we see ETH really start to move sharply lower in Bitcoin terms, then as I run down my watch list here, that makes me think that aside, outside of just like the top high performing alts like Tron and Hype and maybe just two or three others, outside of those, if ETH really starts to move lower in Bitcoin terms, it makes me think that all altcoins, except for like the top three, will really, really start to move back down towards their bear market lows from last bear. So this is ugly. This is ugly looking for ETH, and the fact that the Nasdaq just goes up and Bitcoin doesn't, and altcoins certainly don't either. Um, Imagine what happens if this ever starts to correct. Like, Bitcoin at 77K with the NASDAQ going straight up, Bitcoin's got a higher level of volatility than the NASDAQ. So if we just measure from the lows, yeah, that's great. Bitcoin went up by 36%. Okay, awesome. But the NASDAQ, since those lows over the roughly a similar period of time, the NASDAQ is up nearly 30%. So yeah, Bitcoin is up, maybe a couple of percentage points more, but you had to take on much, much more risk to generate those returns. So if you're holding Bitcoin and it does 36% over 8 weeks versus the NASDAQ, which has done 29% over 8 weeks, which is a phenomenal return for the NASDAQ. But the NASDAQ's volatility is half that of Bitcoin's. Well, if you held Bitcoin, you underperformed on a risk-adjusted basis. Even though, maybe you made a couple more dollars in US dollar terms, on a risk-adjusted basis, you massively underperformed just holding tech stocks. Like you could literally hold just like a basket of tech stocks and have done better on a risk-adjusted basis than holding Bitcoin. And it gets even worse when you start to take a look at altcoins outside of something like Hype or Tron, or that's about it. But if you take a look at ETH, over that same period of time, ETH did 40%, but ETH's vol is like, very, very high. So in fact, I want to check in on Ethereum's volatility. I haven't taken a look at this recently, but a good way to find ETH vol is to hop on over to Deribit and bring up the Ethereum volatility index, the D-vol index. So Ethereum volatility has been moving sharply lower. So yeah, 48% on vol, that's very, very low, very low. So yeah, wow. Interesting. Ethereum's vol has collapsed. And so what that means is you don't get the same magnitude move. Now I'm just waiting for a sharp spike in volatility as a result of ETH moving sharply lower. That's what I'm looking forward to here. But because I think that we're still in a bear market. I think that this is still a Bitcoin bear market. We've still got a couple months left, and there's a prophecy. The prophecy is that these bull and bear markets last for a certain number of days on average, and if the prophecy is right this time, well, then we will have found the lows for Bitcoin by Q4. The start of the fall, the beginning of Q4, we should have found the lows for BTC. And yeah, that's basically what I'm what I'm waiting for here to start buying. But for right now, I'm short. And I mean, there are some interesting opportunities on the long side, though, Mike. That's like hype. Hype looks pretty darn good. If we just check that one out real quick, this is a big move. And if hype can consolidate its gains above this, what is now a level of support, if it can consolidate gains, it could definitely push. It could push to maybe 100. Because these are once you start to get into price discovery, which hype is basically in right now, then you start to target like big round numbers, like psychologically important numbers. Something like 100 on the upside here. Let me just change the color of this. So $100. If it's trading for 57, then 100 seems like a decent target. Something that I like to do whenever I'm just trying to, figure out, hey, where could an asset go? Is I like to sometimes use a fib, use like a Fibonacci, and I could actually use an extension here rather than a retracement. So I'm just going to go from the lows to these highs, and I'm going to drag this down. And yeah, the 618s, these are always important. So 1.618 extension, it's at 95 bucks. That's pretty close to 100. So I would think that somewhere up in this zone, if hype continues to push, would make sense, for an upside target, and that could happen quickly because these things move fast. So I like hype because they make money, and they use those revenues to buy back the token. So
Mm.
if you hold the token, there's actually value accrual there for you. Same thing with Tron. It's just that Tron. It would not surprise me if Tron breaks out above 37 cents and then immediately runs up to 45 cents. That would not surprise me at all. But it hasn't broken out above this level of resistance yet. It's still trading below that 37-cent level. So I've got my eyes on Tron, though, because I might want to open up a levered long if this one breaks out above 37 cents. And then another one that I'm watching closely is Zcash. If Zcash is able to break out above these recent highs at 750, well then this one's got a relatively small market cap. Just compared to many of its, there really aren't many competitors. Actually, we've really only got one real competitor, and that's Monero. But they've got a significant upgrade in testnet right now. Zcash does, and yeah, would not be surprised to see this one break out too. But I, even though hype and TAO and Tron and Zcash and maybe Monero to a lesser extent, even though these are hype definitely performing really well, I still think that if Bitcoin really starts to move sharply lower down towards 50K, that it would probably drag everything else down with it. So if we go hype BTC, something like this, just to take a look and see. So, I mean, this is massive outperformance. So if Bitcoin gets a little bit of a drawdown here, it would not surprise me to see this also pull back. But if hype doesn't pull back and in fact moves higher, when or if Bitcoin draws down a little bit, that is just a massive sign of outperformance. So I would definitely continue to watch hype. I would continue to watch Tron. I haven't taken a look at Morpho in the last couple of days, just kind of curious because Morpho has been just soaking up TVL that's been exiting Aave. So Morpho's been able to hold above that 200-day moving average. That's a positive sign. So yeah, watch for $2.80 on the upside for Morpho. But yeah, that's some interesting stuff going on. Now, I want to take a look at some of these Bittensor TAO subnets, Mike, because there's some cool stuff going on over there on Bittensor, and with everything that the mistake that I made allowing Vertex AI on Google Cloud to run up a massive bill, which I'm going to have to pay today. I'm thinking to myself, well, what if I could use shoots? So shoots is subnet 64. And on Bittensor TAO, you've got all these different subnets, right? So shoots is the one that I want to start with because maybe, I don't know how I could do this, but I could, definitely learn about it today. Maybe I could replace the AI inference, coming from Gemini and Vertex. I could replace that with shoots. So this subnet 64, this one is decentralized. I believe this is like decentralized compute or decentralized inference, but I don't know exactly how this works. So I want to learn about shoots. And then from there, I want to take a look at subnet 82. This is called compel. And then from there, I want to take a look at dTAO. And dTAO is subnet 118. So a dTAO is the alpha token that I'm holding right now. But I'm really interested to take a look at compel and shoots. And in fact, why don't we actually just start with dTAO? Because this is the one that I'm holding right now. So here we go, Mike. Let me play this and let me know if you can't hear this. There we go. Hit play.
Can't hear it.
I wonder why StreamYard does that. Okay, let me remove that, stop the share, restart the share. There's dTAO. There it is. Awesome. Okay, so let's check out dTAO. This is subnet. I think that this is subnet 112.
Structures, only to have them. If you watch this metallic core rapidly assemble complex geometric structures, only to have them instantly dissolve into dust, you are looking at the core architectural vulnerability of modern agentic AI. Transformer models are entirely stateless across independent inference cycles. They process complex in-context tokens perfectly in the moment, but they retain no structural memory of past interactions. In standard software ecosystems, developers patch the famnesia using centralized retrieval-augmented generation, or RAG pipelines, which temporarily store the conversational state. Relying on centralized databases to store user preferences creates severe privacy risks, locks developers into proprietary vendors, and fragments operational data into disconnected silos. To resolve this limitation, Bittensor Subnet 118, operating under the name dTAO, establishes a decentralized stateful alternative to those centralized RAG frameworks. dTAO coordinates a global network of incentive-aligned nodes to function as a persistent second brain for autonomous AI agents. The network ingests disjointed conversational histories and tool execution data, processing them into a secure, globally accessible structure called a semantic knowledge graph. Moving memory from centralized corporate servers to a decentralized incentive layer is mandatory for creating autonomous workflows that can persist and evolve over long operational horizons. Subnet 118 processes conversational data across a specific multi-layer cognitive architecture, with each layer optimized for different latency and recall requirements. This 3D pyramid illustrates the storage framework. The illuminating base handles short-term context ingestion, capturing live conversation tokens and execution telemetry for immediate access. When the middle tier activates, it initiates episodic long-term memory, compressing those loose particles into rigid, time-stamped blocks. This episodic layer allows agents to reconstruct chronological user activities across disconnected sessions. Finally, the top pyramid tier activates, the semantic knowledge graph. The time-stamped blocks explode outward into an interconnected web of conceptual nodes linked by bright lines. At this highest layer, the system automatically runs named entity recognition, identifying key concepts and clustering related relationships into distinct subjects. Instead of relying on traditional, localized keyword matching, this semantic clustering allows agents to trace how workflows, ideas, and user preferences evolve over multiple months. By parsing unstructured data into these three distinct structural tiers, dTAO prevents the severe context dilution that routinely breaks multi-agent workflows in standard sliding window models. The core operational challenge of this system is executing these complex semantic retrievals across a distributed ledger without relying on a centralized coordinator. The query lifecycle begins when an external user application or an autonomous agent issues a memory request to a Subnet 118 validator. During the distribution phase, the validator wraps the request into a standardized Bittensor synapse and propagates it outward to registered miner nodes across the network. To complete the task, miners must calculate cosine similarity against their local vector databases to locate the precise semantic embedding requested by the validator. Validators enforce strict latency penalizations, heavily decaying the scores of slow responses. Prompt millisecond-level memory retrieval is non-negotiable for real-time agentic execution. To secure the network, validators implement anti-collusion protocols, including cryptographic response signing, to prevent low-tier miners from simply intercepting and copying high-performing responses. Validators also actively hunt for stale data by deploying synthetic, non-deterministic queries and forcing miners to continually synchronize their databases with verifiable block timestamps. This specific competitive scoring loop guarantees both the speed and the semantic integrity of the memory output, all without requiring a single trusted intermediary. Transitioning from theoretical protocol design to the current operational reality of Subnet 118 metagraph reveals a highly unusual node allocation profile. Looking at the highlighted network metrics, Subnet 118 has a maximum capacity of 256 node registrations, with 14 active validator nodes. If we isolate the active miners row, a critical anomaly emerges. Exactly one active miner produces memory outputs for the entire subnet. This extreme asymmetry introduces a severe systemic vulnerability. If that single active miner experiences hardware failure, the subnet's operational retrieval capacity immediately halts. Under Bittensor's UMA consensus mechanism, however, this metagraph asymmetry creates a highly lucrative economic opening for incoming node operators. Because rewards are distributed based on competitive performance, that single active miner currently captures the vast majority of the nearly 82% emission split allocated to performance incentives. While dTAO's multi-layer memory architecture is sound, its immediate survival depends entirely on bootstrapping a competitive marketplace of new hardware miners to distribute the operational load. Subnet 118 integrates directly into Bittensor's dynamic TAO, or dTAO framework, moving its economic model from centralized validation to a decentralized liquidity system. Under dTAO, Subnet 118 operates as an independent automated market maker pool, facilitating direct exchange between the core TAO network currency and the native SN118 token. This diagram illustrates the constant product formula governing the pool. As the TAO reserve increases, the SN118 reserve proportionately decreases, shifting the exchange rate curve. Because swaps execute directly against reserves, a massive unstaking order triggers a steep vertical drop, causing significant price slippage. This slippage acts as an economic stabilization mechanism. It actively penalizes speculative capital flight and rewards long-term, stable staking commitments. Beyond AMM mechanics, value accrual is driven by demand-side integration, specifically the commercial activity flowing from the consumer-facing HeyDitto.ai application. Through the Subnet stake burn module, the subnet owner can use the real-world API queries generated by users to permanently remove minted alpha tokens from circulation. By mathematically linking real-world application demand to a deflationary token burn, the network grounds its economic valuation in actual utility.
Wow, that's actually really interesting. So, Mike, did you catch that part there about so basically this is like a Hermes agent. This is like kind of like an OpenClaw Hermes agent, something like that, but on Bittensor. It's its own subnet, and the actual real world use of this subnet 118, this ditto subnet, when users call the API, it looks like that can actually burn the alpha token permanently, or burn some of those alpha tokens permanently. So real world use of the protocol of this subnet 118 results in deflation for the token.
So,
That's,
so now in the tokenomics, is there a fixed supply or is there a minting mechanism or?
man, I see. I don't know. But what I
Because that I'd be interested to know because it sounds very similar to Canton. If there's a minting mechanism, if there's not a minting mechanism, there's a fixed supply. That's even better.
Well, I mean, yeah. See, what I know is number go up. That's what I see here.
Oh,
So
absolutely.
yeah, I mean, this thing. If we just measure this, let's see, price range. We measure from trough to peak. This is literally just the last 30 days. Last 30 days, a little bit more than a 10x. So this website here, this taostats.io website.
Hmm.
It's got these pop-ups from these things. That's super super annoying. You see that? I didn't click on anything. It just popped up, and so now I got to let it. Yeah, but so a 10x in the last 30 days, and it's still at a $13 million market cap. So that's tiny. So this thing, is new. This is a new project here, new subnet, um, just starting to gain some traction. And yeah, I'm thinking to myself that this one could run another 10x, because some of the largest subnets on Bittensor are like 120 million. Um, so if this is sitting at 13 million, I just need to be able to actually use this. Like, how do I
Well,
actually
like,
use this thing?
and where do you get a hold of it?
Well, so swapping into the alpha token is easy enough. So all you got to do is number one, create a BitTensor TAO wallet. I use Talisman, and then once you've done that, you've got to seed your wallet with some TAO, and then once you've got some TAO, then you can swap in to the alpha token. Um, so these alpha tokens, you're basically staking TAO, and as a result of staking it in the AMM, you mint the alpha token, which you then receive in your wallet. So the alpha tokens are, almost like shares of stock in a company, and the company is the subnet, and the product that the subnet produces is, just broadly speaking, it's intelligence in some form or other. But this one, it looks like I could actually use this one for, like, creating agents, maybe. I
Mhm.
think so. Yeah, but the tokenomics here, they sound quite good. They really do. So we've got a minute left in this one. Then I want to take a look at the slide deck for Ditto.
rather than pure speculative trading. To defend its market share in the wider AI landscape, Subnet 118 is aggressively expanding its interfaces with external developers to create a technical moat. The immediate roadmap focuses on scaling via the Model Context Protocol, allowing Ditto to expand integration directly into native consumer platforms and enterprise workspaces. This focus on dynamic, real-time conversational clustering separates Ditto from adjacent storage subnets that only provide static bulk ingestion and cold storage retrieval. The overarching macroeconomic risk facing the network is validator attention bias within the broader BitTensor ecosystem. Validators have limited voting power. If they prioritize larger, higher revenue compute subnets, smaller utility subnets risk losing their root level staking allocations, threatening their economic viability.
Hmm.
Despite these operational risks, Ditto has successfully engineered a decentralized persistent context layer specifically optimized for autonomous multi-agent pipelines. If Subnet 118 resolves its centralization bottleneck and maintains developer adoption, it is positioned to serve as the foundational memory layer for the decentralized web.
Wow, wow. So no wonder it's performing so well. But here's the thing, Mike, I still don't quite understand this thing. Like, I get like the high level overview of this, but I
Mhm.
still don't quite understand how I can use it. So let's see what we can learn from the slide
You mean
deck.
you mean the actual tech, not necessarily the token, but actually, what is the utility of the actual project?
I mean, I get it at a high level, but if I wanted to actually use this,
Mm,
how would I actually use this? So, when and this is something that I've had a problem with, building these Hermes agents or the OpenClaw agents when I built those too. It's I can get them to the point where they work, and then they start to forget, and then things break. And so
mm,
it's we're talking here about structural amnesia. So let's see, this is all for AI agents. And these AI agents can have wallets and they can perform real world actions and buy and sell stuff. So they're starting to become more like, humans. Um, so it says here, while large language models process complex in context tokens flawlessly, they lack a persistent structural memory across independent inference cycles. Right. So, basically they lose their context. Okay. Subnet 118, a stateful memory paradigm. So, Ditto is a decentralized digital commodity market operating on the Bittensor mainnet, acting as a persistent second brain for autonomous agents. Okay, great. How do I use it? So if it's a second brain, how do I use this thing? So global coordination, unified graph, agentic access. It says provides a shared context layer where multiple AI agents securely store and retrieve personalized user memories. Okay, so at a high level, I get what this is, but how do I use it? The multi-layer memory storage framework. Okay, short-term context, long-term memory, and a knowledge graph. Awesome. So this is how it maintains its statefulness. Okay, from unstructured text to semantic concept clustering, semantic recall versus keyword matching, proprietary. Okay, local developer tools are open source. The mainnet production machine learning models and synchronization protocols remain proprietary to defend the technical moat. Okay, great. How do I use it? So the minor validator query lifecycle. Okay, number one, request ingestion. External applications or autonomous agents issue a contextual query or memory commit to a Ditto Subnet 118 validator. I'm assuming that this is just through an API call, that it just you call this subnet and do stuff with it. I'm assuming. Okay, so step one, request ingestion. Step two, query distribution. Okay, the validator wraps the request into a standardized BitTensor synapse and propagates it to a minor axon endpoint. So this is part of the BitTensor TAO, like how BitTensor TAO works. The synapses, the minors, the axons, the endpoints. This is all terminology specific to BitTensor TAO. Okay, execution and generation. Step three, minors generate relevant embeddings. Okay, so that it must be an API call in step one. And query the localized semantic graph. So that's memory, and return formatted memory states. Got it? Okay, and then four, this is determining how valuable is the output, the generation. So validation and scoring. Validators receive minor responses and score them across the on-chain metagraph. Okay, defense mechanisms, evaluation metrics, and anti-collusion protocols. Okay, and let's see, I think that this finally finished. Okay, great. So I just updated the newsletter and I think it just shipped to production also. Let me see if that run, yeah, 4 minutes ago. Good. So it did. And I switched the newsletter generation to a different model, and it definitely is going to reduce those costs. Okay, back to BitTensor TAO and Ditto. So defense mechanisms, evaluation metrics, and anti-collusion protocols. Okay, great. operate the metagraph asymmetry, data terminal, Yuma consensus. I'm trying to figure out how to actually use it. I think that it might just be a matter of calling the dTAO API. I think that's probably how you use this thing. Okay, tokenomic operating dashboard. So, all right, trading volume, market cap, supply 1.9 million, theoretical diluted cap 87 million based on scaling emissions. Hey, bro, that's an 8x. That's the theoretical 2035 diluted cap. Emissions split. And okay, great. Value accrual, deflationary mechanics, and demand ingress. Okay, so demand side integration. This is path one. Oh, there it is. HeyDitto.ai. Commercial activity via HeyDitto.ai features a pay-as-you-go credit model. External agents executing memory queries route real economic value back to the node. Okay, let's check this out. HeyDitto.ai. HeyDitto.ai. Here we go.
For your agents.
Yeah, look at this. Okay, so this is how we use it. The smart home for your agents. Organize your content, organize the context your agents need, then operationalize it across every thread, tool, and workflow. Ditto gives your AI a shared place to remember, retrieve, and act. Awesome. Okay, connect agents. Hell yeah. I want to connect my Hermes agent to this thing. Okay.
So it looks like it augments, like the existing AI. So, like almost like a secondary check or something. So maybe this would help with that. How you get stuff working and then it just kind of goes off on its own and breaks.
Right.
Maybe this would help mitigate that.
I think it could. And if I take a look here at, okay, so core features. This looks pretty cool. Visualizing your memory network. Let's take a look at pricing. Start free, then pay as you go. After 30 minutes, you pay per use in credits. Different models cost different amounts. Ditto shows you the cost of each message before you send it. Cap it if you want. Set a monthly spending cap. Start free. Okay. Sign into Ditto. Oh yeah, man, I'm definitely going to use this thing. This looks pretty darn cool. Okay, so that's how to use it. HeyDitto.ai. So, okay, great. And this is what is, creating this structural demand for the token. Because the more you use it, or really the more your agents use it, then the more it gets burned. So, wow. That's a pretty legit connection between like real world use and number go up for the token. I like that. See, this is the type of tokenomics that, we need to search out and find. This is legit. This is super legit. Wow. Okay. So now that we know about, Ditto, I want to see if, because I just ran up that big bill on, $250 in a day for Vertex AI without realizing it on the 3.5, the Gemini 3.5 model. It's not so much the absolute dollar amount, although it is. It's more so that I didn't know it was happening. I didn't know that it was, charging me like $3 or $4 per newsletter generation. And so as I was going through and, iterating on the newsletter, I didn't realize how much it was charging me. So how can I fix that? Well, I think I already did by changing the model in Vertex. But what if I wanted to move away from a Google Cloud model entirely and move towards a decentralized AI model? I know, right? Yeah, that's right, Jeff. The fucking Gemini, man. So, but what if I don't want to use that? What if I want to use Shoots? So Shoots is one of the top subnets on Bittensor TAO. How do I use Shoots to replace the AI inference spend on Google? Can I even do that? Let's take a look at this. I want to learn about how to actually use this thing.
All right, let's jump straight into this explainer. Today, we're taking a look at an absolute powerhouse in the Web3 space. We're breaking down Bittensor Subnet 64, which you probably know by its commercial name, Chutes. So what is this exactly? Well, it's a decentralized, serverless platform engineered by Rayon Labs. The whole vision here is to go head-to-head with centralized cloud giants like AWS Lambda and OpenAI. But instead of relying on one massive corporate entity, Chutes shifts all that machine learning heavy lifting over to a permissionless, incentivized peer-to-peer network.
Here is our roadmap for today. 1. The decentralized AI cloud. 2. Inside Chutes architecture. 3. Journey of an inference request. 4. Scoring the miner network. 5. The SN64 token economy. And 6. Live ecosystem and future.
Okay, starting with section 1, the decentralized AI cloud, scale and performance.
Now, to really wrap our heads around what Chutes is doing, we've got to look at the sheer scale. 100 billion. That is a staggering number. By mid-2025, this wasn't just some fancy white paper concept. This permissionless network was actively processing 100 billion tokens every single day. To put that into perspective, that's an annualized run rate exceeding 36 trillion tokens. This massive volume proves Chutes isn't just an experiment. It's a major decentralized inference provider routing real, substantial traffic.
So how are they pulling off that kind of volume? Well, it all comes down to speed. Chutes uses what's called an instant start container architecture. Because they keep their base layers permanently hot and cache weights locally across the GPU pool, they've managed to crush model cold start times down to just 200 milliseconds. That is literally 10 times faster than typical cold starts on traditional cloud platforms. And when loads are steady, the average response latency drops below 50 milliseconds. Why does that matter? Because real-world, real-time web applications demand that blink-and-you-miss-it performance. You just can't compromise on latency. Moving right along to section 2, inside Chutes architecture, anatomy of a network.
To hit those incredibly low latency numbers we were just talking about, Chutes is incredibly strict about its physical setup. We're talking dedicated bare metal servers only, no shared virtualization allowed. The core software modules running this raw speed are actually a really cool mix of dedicated development and community support. Rayon Labs handles the heavy foundational lifting, stuff like the developer SDK, the miner software orchestration, and the GPU validation library. But then the community, specifically the miners union, steps in with essential tools for node orchestration and cleaning up orphan GPUs. It's a genuinely collaborative ecosystem.
Inside a miner's actual infrastructure, tasks get split between CPU control nodes and GPU worker nodes. But here is absolutely crucial detail for stability. The network forces a strict 1-to-1 RAM to VRAM ratio. So, for example, if a server has 4 A40 GPUs and each has 48 gigabytes of VRAM, that system absolutely must have 192 gigabytes of system RAM. No exceptions. Why? Because it completely prevents those catastrophic memory swapping failures. It ensures total stability when they're loading these massive AI models into memory.
Now, to manage all these spinning containers, the system uses a module with a pretty fun name, Geppetto. Think of Geppetto as the network's ultimate traffic cop. Its entire job is to continuously schedule, replicate, and scale container instances across the cluster. It constantly monitors user-defined parameters like concurrency limits and scaling thresholds, so it knows precisely when to spin up a new instance if a queue starts backing up, or when to shut down an idle one, so you aren't paying for unused compute.
But wait, before any GPU worker node is allowed to process a single piece of incoming traffic, it has to get past Gravel. If Geppetto is the traffic cop, Gravel is the strict bouncer at the door. It runs intense, physical hardware-level checks on the graphics card to verify it's authentic and make sure at least 95% of the advertised VRAM is completely unallocated. It literally forces the GPU to solve complex math problems, specifically matrix multiplications, just to prove its true identity before it can even generate a cryptographic key.
Section 3. Journey of an inference request. Firing up the engine.
We've looked at the static anatomy, now let's see this thing in action. Let's trace a live request through its 6-step lifecycle, which is engineered for speed and absolute data privacy. First, the client securely signs the payload with their hotkey. Second, the API gateway validates that signature. Third, a direct socket.io connection is made to the miner on port 32,000. which totally bypasses public pathways and protects nodes from DDoS attacks. Fourth, our traffic cop Geppetto schedules the task. Fifth, the Gravel bouncer tests the hardware. And finally, step 6, the payload is decrypted and the inference executes. It's a beautifully secure, lightning-fast pipeline. Moving on to section 4, scoring the miner network, the miner dashboard. Now, in a decentralized cloud, you don't have some corporate manager making sure everyone is doing a good job. Instead, validators evaluate the miners using what's called the UMA consensus weight formula. Validators run this off-chain math to figure out a miner's consensus weight, and that weight is what actually dictates the token rewards they receive on the blockchain. Okay, let's translate that complex formula into human terms. It basically boils down to 4 actionable metrics. First, compute units. This measures active work, like your tokens per second, normalized against the network median and adjusted for your specific GPU. Second is the invocation count. That's just the raw volume of successful requests you've handled. Third, the unique CHUT score. This rewards miners for diversity, tracking the average number of unique models running at the same time. And fourth, the bounty count. Basically, how fast a miner claims network deployment bounties. If you want to make money mining on CHUTs, this is the scorecard you need to obsess over. Section 5, the SN64 token economy, fuel for the engine. So what is fueling this entire ecosystem? Well, the economic model operates in a really fascinating way. With the launch of the dynamic TAO upgrade, Subnet 64 got bound to its own automated market maker pool. This pairs the native Bittensor TAO token directly with the Subnet's own token, SN64. It uses a constant product formula, which is basically a strict mathematical rule to ensure the pool stays perfectly balanced. If you stake TAO, it mints equivalent SN64 to you. When you unstake, you withdraw TAO, and the returned SN64 is burned. It is a brilliant, dynamic, self-balancing liquidity machine. And this is where the...
Yeah, Mike, did you say something?
Oh, it keeps calling it TAO.
Yeah, TAO.
Economic innovation really hits the nail on the head. On one hand, you have real-world utility. Developers are actively paying for compute resources per token, using either fiat or TAO. But on the other side, you have a programmatic buyback system. Every bit of that revenue routes directly into an auto-staking module. Think of it like a vacuum. It automatically executes swaps, alters the pool reserves, and programmatically raises the spot price of SN64. Those newly acquired tokens are then automatically staked directly to the top-performing validators. It's an automated feedback loop that directly connects real-world usage to token value. Finally, Section 6, Live Ecosystem and Future, the dashboard today. We've seen the hardware, the software, and the economics. But who is actually trusting this network right now? The space is currently dominated by massive, highly capable open-weight models. We're talking major architectures from creators like Alibaba and Moonshot AI, executing millions of inference requests. And notice that TEE tag next to those models? That stands for Trusted Execution Environments. CHUTS uses these highly secure enclaves to completely protect data privacy. They are proving to the enterprise world that decentralized networks can handle highly sensitive proprietary workloads safely. Which brings us to a really massive question. We've just explored a permissionless network that pulls off 200 millisecond cold starts, maintains sub 50 millisecond latency, and blasts through 100 billion tokens a day, all while reinvesting its own revenue to fuel growth. It absolutely forces us to ask, is this kind of highly incentivized decentralized architecture simply the inevitable future of AI cloud computing? Are we literally watching the centralized giants get outpaced by a network owned entirely by its participants? It's going to be a fascinating space to watch. Thanks for joining me on this explainer, and definitely keep questioning the architecture of the web around you.
Wow. Okay, so shoots. I still don't quite understand how I can use this. So, as it was going through and, just describing the shoots architecture, I was thinking to myself, well, I could definitely, I already replaced a Gemini 3.5 Flash, that super expensive, brand new Google model with a much, much cheaper model. But I could go one step further and replace Google entirely with one of the Chinese models, like the DeepSeek model. And the DeepSeek version 4 Flash for the newsletter is like DeepSeek's V4 is super, super cheap, super cheap. So, and better than the Gemini 2.5 and Gemini 3.1 models. So that would be a way to like use a centralized model to reduce costs for that newsletter product even further. But what if I could use shoots for that compute instead? I don't know how I can do that. So I just want to run through this slide deck really fast because I've got one more piece of video content that I want to play through today. Okay, so intelligent platform as a service, physical hardware constraints, 50-second journey. Okay, so client signature, API gateway call, miner control node, K3 kubelet, Graval challenge, LLM. Okay, executes within fewer than 50 milliseconds. Okay. And evaluating off-chain miner. So Yuma consensus determines, the value. And this is when you swap into the token. There's that formula, X times Y equals K. The auto staking module converts fiat revenue into programmatic token demand. Yeah, it's not really working all that well though, because if you take a look at the Shoots token, so if we hop back on over here to these subnets, and if I in the search here type in Shoots, and we take a look at this subnet 64 Shoots. So yeah, this isn't exactly the type of performance that you want to see, right? This is not good. So obviously there's something broken with their tokenomics. So you can see over here the subnet 64 Shoots. This is just not what you want to see.
Bleeding out.
Yeah, bleeding out. So there's definitely something wrong with these tokenomics, especially when you compare it to something like dTAO, which is just crushing it. So defending against minor liquidation, okay. Subsidy paradox. Oh, wow, there you go. 40-to-1 token inflation. Oh, man, okay. So it says, Shoots claims an 85% discount over Amazon Web Services, but without network inflation subsidies, it is 1.6x to 3.5x more expensive than centralized Web 2 alternatives. Okay, so unsubsidized Shoots, and here's DeepSeek v3. So DeepSeek v4 is really good and super, super cheap. So yeah, I think what I'm going to do for the newsletter is I'm going to move it to DeepSeek v4. TAO flow dynamics and the latent risk of rapid capital flight. Okay, so I think I've seen enough about Shoots. Look, the market is going to tell you what you need to know. And when I look at the market, I see, number go down. So yeah, it's really, really cool that this thing's got $100 million market cap. It's decentralized compute, but obviously the tokenomics are broken. So yep, I'm going to pass on Shoots. Let's take a look at Compel. This is adversarial LLM debate dynamics. I don't know what the hell that means. So let's learn about this a little bit. Here we go. This is going to be the last piece of video content I've got for us today.
Can't hear it.
Okay, let's go ahead, start that screen share over. And here we go. Compel. This thing is called Compel. And what's the subnet for this one? I think it's subnet something or other.
Modern artificial intelligence faces a severe bottleneck in its training pipeline: the reliance on static reinforcement learning from human feedback. This traditional RLHF methodology is constrained by high operational costs and human labeler bias. It also fails to dynamically scale a model's logical reasoning depth. To solve this, we look to Bittensor Subnet 82. Originally launched as Hermes, this protocol gained early momentum through acceleration by the Yuma Group and Barry Silbert. Hermes was built to bridge the Web3 data gap by translating raw, unreadable hexadecimal blockchain logs into clean, structured GraphQL endpoints for decentralized applications. However, as of 2026, the subnet slot executed a hard pivot. It abandoned indexing entirely and transitioned into the Compel protocol. Compel operates as an automated game-theoretic arena. Instead of indexing logs, it pits large language models against one another in structured verbal conflicts. Forcing these models into strict, autonomous adversarial debates generates a continuous stream of multi-turn reasoning data. This output provides the resources needed to replace static human feedback. Subnet-72 functions as a specialized cognitive engineering layer, shifting the network's focus toward manufacturing high-value reasoning datasets at scale. To understand how Compel manufactures this data, we have to examine its operational mechanics. The subnet runs as a continuous, epoch-based tournament system rather than processing ad hoc end-user queries. The miner's workload reflects the structure. They do not process real-time requests. Instead, they formulate written debate strategies and commit them directly onto the Bittensor blockchain. These committed strategies operate as rigid system prompt constraints. They dictate exactly how a miner's agent will approach logical formulation and rhetorical style during a live match. At the start of each epoch, the network's validators take over. They parse the metagraph for NetUI 82 to extract and verify all active on-chain miner commitments. With the strategies loaded, the validator engine pairs eligible miners into designated pro and con matchups, orchestrating a massive round-robin tournament. The specific matchup ordering and topic assignments are deterministically seeded using the hash of the starting block on the Finny mainnet. This mathematical seeding guarantees fairness across the cohort. Validators extract required metadata fields from remote topics, the core motion, context, framing, and data provenance. These structures then route debate logs into an LLM judge, evaluating logical consistency and rhetorical strength to output a definitive numerical score. These judicial decisions trigger an immediate update to the participating miners' global ELO ratings. Those ratings are then normalized into consensus weights and written back to the blockchain. Through this closed evaluation loop, Compel establishes a mathematically rigorous and tamper-resistant pipeline for scoring the highly abstract concept of linguistic persuasion. This raises a critical architectural question. How do validators execute hundreds of complex LLM inferences every epoch without requiring massive, localized GPU clusters? The answer lies in their low-overhead deployment model. Compel validators actually operate on highly modest CPU hardware. Compel offloads computationally intensive inference tasks directly to Subnet-64, known as CHUTS. It acts as an enterprise customer, paying query fees for every model invocation. This frees Compel validators to manage only high-level tournament logic. When compared to competitors like Fetch AI or Ritual, Compel takes a distinctly different approach. It explicitly avoids competing for raw hardware dominance. But this introduces a structural risk. Any network degradation or API outage on Subnet-64 could prevent Compel validators from completing their epoch within the strict block timeout window. By fully modularizing its architecture, Compel eliminates physical capital expenditure barriers, but it directly converts those savings into rigid network dependency risks. To fund this entire data generation loop, we must examine the underlying economic engine, the dynamic TAO framework. Subnet-82 issues its own native utility token, known as the alpha token. Its value is inextricably linked to the main Bittensor TAO token. The constant product automated market maker pool dictates the TAO and alpha exchange rate. From this invariant, we derive the spot price, shifting dynamically based on the reserve ratio. When nominators stake TAO, they directly increase the subnet's global initiation share. This leads to specific structural vulnerabilities based on Subnet 82's configuration, which enforces a strict maximum cap of only 64 active miner slots. The wider Bittensor network enforces a hard ceiling of 128 total subnets. If Compel fails to maintain high capital inflows and an attractive yield, the network will prune it from the mainnet entirely. To prevent pruning, the protocol uses two deflationary token sinks. First, it routes all miner registration fees into the local liquidity pool. This locks TAO out of circulation and bolsters the alpha token price. Second, it requires external developers and researchers to continuously spend or burn alpha tokens in order to query the live engine and access the generated debate datasets.
Okay, so that's super important. So, as we're going through this more and more, um, I'm starting to notice that the protocols, or not protocols, the subnets on Bittensor TAO
Mm.
that perform best. If we just take a look at the subnets real quick, go back to the homepage here, and I'm sorting by 1 month performance. And if we just take a look at some of these, the two that we're looking at today, Ditto and Compel, hey, there is a reason why over the last month they're up 6x and 4x respectively.
Mm.
The reason is because the tokenomics are awesome. Like, if you want to use Ditto, you're going to burn Ditto alpha tokens and number go up. If you want to use Compel, same deal. Those tokenomics, that's what we're after. All of the research that we do, we're basically looking for really good tokenomics. And these two subnets have great tokenomics. If we take a look at Compel, just looking specifically at Compel, and I zoom out here, and this, look at that chart. Wow, look at that thing, man. So, it's trading for a penny. It was up at $9 at one point. Wow. Wow. So I wonder what happened here. April 22nd, that was a couple days after the layer 0 exploit. I wonder if there's anything to do with that. I don't know. Maybe not. But dude, that was a 456,000% move. Like, so if you had $1 in this, then you did really, really well.
Yeah.
Have there been any other similar moves like that? I don't think so. I'm just going back in time here through the data set just to see, like, has it ever performed like that in the past?
The very beginning.
Yeah, but this is more of a dump. Dude, a 400,000% move. Like,
Yeah.
let me just get $10 in here, okay? You know what I mean? Right? So, yeah, but tokenomics, we're always hammering on tokenomics. You know,
Mhm.
the tokenomics have to be legit. If they're not, then I can't touch it. So here we go. Let's play the rest of this video.
Compel's technical design is irrelevant if it fails this economic mandate. Long-term survival requires maintaining an aggressive balance between emission-driven inflation and the continuous burning of tokens through organic demand. Beyond the economics, Compel faces severe internal consensus risks that threaten the integrity of its evaluation loop. The most prominent is weight copying under the UMA consensus. Lazy validators can simply copy the scoring matrices of top performers to avoid paying their own Shoots API query fees. There is also a critical software supply chain risk embedded directly into the subnet's deployment pipeline through the Compel Watchtower auto updater. By default, this watchtower pulls new code from the GitHub main branch every 10 minutes. A single malicious commit could compromise the entire active validator cohort almost instantly. The required technical mitigation is manual intervention. Node operators must override their environment variables to strictly demand verified GPG-signed releases from the core maintainers. Despite these dense technical and consensus vulnerabilities, major enterprise capital continues to flow into this specific subnet. This is because Compel serves a lucrative external use case, acting as a live adversarial simulation engine for prediction market analytics.
Hmm.
Financial institutions and traders source debate motions from platforms like Polymarket. They use Compel to pressure test market sentiment against optimized LLMs, forcing the models to surface underlying structural risks before they manifest in price action. Compel demonstrates that decentralized AI reaches its full potential by engineering game-theoretic frameworks that transform raw compute into highly monetizable cognitive truth.
Wow, man, this is some cool stuff. I'm really liking what I'm learning here about Bittensor TAO and a handful of these subnets. And I see Jeff is saying, make sure to get those push-ups, pull-ups, and squats done right after the show. Fuck yeah!
Yeah. I
There
went
we
up to the
go,
I
dude.
went out to the island yesterday with the kettlebell and was doing halos and freaking swings and everything.
Hell yeah, dude. Well, you better believe it, Jeff. I'm gonna be, I got a little mat right here. You see, I've got a floor where I live, and so I can use this floor as my exercise equipment. So that's all I need, man. Is a floor and a pull-up bar, and I'm good to go. But I'll definitely be doing that right after the show. So I want to take a look at, I want to take a look at more of these subnets. So I mean, I'm not gonna lie, this nearly 500,000% move right here. Uh, that's pretty interesting. That's you know, muy interesante. But let's see, what other subnets do we have going on here? So we were taking a look, we just looked at Compel. The one that we were looking at before that is Ditto. And then we also looked at Shoots. And even though Shoots looks like it could be useful, um, yeah, I don't know, man. It's all about tokenomics for me. And Shoots, I don't think it passes the smell test. So, and what are these unknown subnets? What are these? Um, because the tokens have done pretty darn well, but I don't know that I could swap into an unknown like this. I mean, look at that shit though, man. I mean, what type of multiples are we talking about here? Like,
I'd
this
be I'd
is,
be I'd be interested to know if there's any of the the subnets that haven't made these big moves yet that are doing anything of note.
I mean, dude, Mike, look at this performance though. This is an hourly chart. Okay. So we're
Yeah,
talking about this is like, earlier today. Earlier today, this thing was up 7x. This is like meme coin type stuff going on here. But I have no idea what this actually does. The market cap is down 80%. Are there scams on Bittensor TAO? Like, are some of these subnets just straight up scams? Like, because when I look at the volatility of these tokens and the volatility of the market cap, it makes me think that, is there rugging going on here for some of these? Like, wasn't there a subnet? Wasn't there that black dude who like got in really good with the founder or one of the founders of Bittensor, and he basically rugged like $10 million from a subnet. It
I
was like
don't
a
I don't recall.
Yeah, so I read about it, and so I think that there are potentially like you know things to be on the lookout for when it comes to some of these subnet alpha tokens. So, for me, what are the metrics that we have to be tracking? Because, it's super easy for me to just sort by performance over 1 month, but what are the other metrics that we need to be tracking here? So it looks like net flow change. Okay, flow 1 day. Let me sort by flow. Okay, so if I sort by flow, then I'm also going to look at a monthly performance. There's Ditto. There's that unknown one that looks kind of funky. So I don't even know what flow means. I'm assuming that flow means staking flow, where because it's denominated in tau. So I think what this means is, yeah, net flow change. I think it means if you're staking tau to receive the subnet alpha token, I think that is staking flow. Pretty sure, but not positive. Okay, what's this? Chain something or other? Chain what? Chain buys. What the hell is a chain buy? Okay, chain buys in the last day, 296 tau, and that's for the Nova subnet. So yeah, there's some interesting stuff going on here for sure. Let's take a look at performance over the last week. What's GM? GM over the last week plus 35%. Not bad. There's Ditto. Mantis. So I've got so much more work to do on these subnets here, Mike. These look like some interesting opportunities for sure.
And like I said, if we can identify some that that are good, that haven't made those big moves yet, there might be some opportunities there.
Exactly. Well, I'm focused on Ditto first. So I've got my work cut out for me for the rest of the day today, and all I'm going to do here is finish that newsletter. I'm going to migrate the LLM model over to a DeepSeek V4. Hopefully, be able to finish that newsletter today. I got to get that off my list so that I can move on to everything else. Yeah, man. So that's what I'm focused on today. And yeah, I think we've run out of time.
Absolutely. All right. Well, thank you all for tuning in. And if you want to join us later on for the rest of the shows that we have on today, we got the daily market wrap, about 20, 30 minutes of technical analysis at the market close at 1 p.m. Pacific, 4 p.m. Eastern. And we have myself and Jeff tonight is Crypto and Chill, which is at 5 p.m. Pacific, 8 p.m. Eastern. So if you want to join us for either of those. And, of course, this weekend we got Sovereign Soil, Saturday Night Fever, and Gaming and Chill as well. So if you want to join us for any of those, we'd love to have you. And have a great day. And until next time, Veteran Crypto out.
Peace.